We make these expectations today, so hence the T, the conditional T notation, and we are working for, in the case of stocks, of an infinite sequence of expectations that we need to discount, and then we will use as a discounting factor something that we call the cost of equity. And that cost of equity is made out of the risk-free rate plus certain premium, which is specific to this particular stock. Each stock will have a cost of equity, which is the return required for the investment in this particular class of investments, and each stock will have a different premium depending on the risk conditions. The expectations, the expected dividends will be the same, maybe the same, but if the uncertainty surrounding is different, we will reflect that in our analysis by charging a different risk premium. That's the cost of equity. When we engage in corporate valuation, it's not just the price of a stock, it's the value of the company as a whole. The whole company, and we follow exactly the same path. We have called the risk-adjusted approach. You will have to discount all the cash flow promised by the company. So we will go from 1 to infinity, because we may have an infinite number of free cash flows to occur. Those are this is the expected cash that this company is expected to generate, and we will discount it with something which we call the WACC, the weighted average cost of capital. The discounted factor here is going to be, again, something that can be written as risk-free rate plus premium. And again, this premium is going to be fairly specific. Each company will have a specific premium depending on the leverage ratio, so equity over the total, weighting that cost of equity, and debt, long-term debt over total, weighting the after-tax cost. We are going to see because of today. We're going to work with bonds, and that yield to maturity of a bond is the cost of that will be the cost of debt for a company. How much your debt holders require for investment, for lending you money, and we will use that combined with how much the equity holders, the shareholders demand. To make this kind of average, it's not just an arithmetic average, it's a weighted average, because if you are relying more on equity, you will demand more, you will sort of overweight the cost of equity, but how much they require and how much this other type of investor requires determine the premium that we charge in order to determine the value of a company. Okay? In the homework, I'm going to ask you to do these sort of things. We will have to talk about homework because we are reaching the end of chapter 1. So tomorrow I will release the first assignment, okay? And we will like that. We will be using this thing. I will introduce in these courses to you, those of you that come from this administration. Those things are more natural. For those of you that come from economics and those things may not be seen previously, I want to take the advantage of introduce these courses. Those are fundamental in finance. This is corporate finance. This course is not about corporate finance, but I want to give you that oversight because it's an error. This is how the undergrads see the world. Okay, this is finance 1, this is finance 2, 2 are related things. That's a huge mistake they make systematically. The current mindset is everything is a part of the total. And the more I pick up, the better I am. The more expertise I get. But you realize when you sort of start the path that you guys are starting, like when I go paradoxically, the more specialized I become, the more I understand that everything is a part of the total. And the more I know about the total, the better I am. So I'm sort of mixing, and you have probably noticed that, I'm sort of talking about in my courses about econometrics, about finance, about accounting, about economics, because everything is part of the thing, the same thing. It's just specializing. Sometimes you need more, you need to know more about those things, but at the end of the day, everything is part. Okay, so.
When would the homework be due?
Due 1 week or for next week. Will be okay?
Yeah, no, I just want to.
I mean, my real constraint is before the exam, everything needs to be done and marked.
Okay.
So this is the real constraint. A couple of years ago, we have the exam sort of very soon, right after the course was done. We had the exam, and that put a lot of pressure in order to be a tighter schedule. But nowadays, knowing that we go to mid-December, to me it doesn't really matter whether the homework is due next week or 2 weeks later. Yeah.
And 2 weeks later,
I mean,
if it doesn't bother you.
it doesn't really bother me. There are 2 assignments. So my requirements is to have time enough to mark it before the exam. So when the exam starts, you all need to know all your marks. Okay? We will talk about tomorrow. I release the homework and we will talk about that. 1 week should be, I mean, you are a team of 3, we agreed finally, right? So that 1 week should be more than enough. And the advantage, the second assignment goes long because we will sort of finish next week, so it's not like it will be later anyway. Later understood as beyond the finish of the course. So I'm okay with that. But the advantage of putting the deadline next week is that, for instance, on Monday we can talk the previous day, right? Before the deadline. So if any has any doubts, we could discuss it here in the classroom. That would be the advantage. If I give you a long deadline, I know what's going to happen. You will not be working until the deadline approaches, because this is something what we do. The first question that we ask when we have to do something is, when is the deadline? Because you will be working like 1 week ago. And it will be like a priority. The more priority to the closer deadline. That's it. That's what happens. So it's an illusion. I give you more time, but just to postpone, just to delay, not time that you will be spending on working on that. And you know what? Because we do the same thing. So 1 week should be enough. Okay, so this is the corporate evaluation approach. This is the what we do. The most exotic one, which is we are discussing at the beginning of this class, is the what we call this neutral approach. We work with an expectation of the payoff, right? It's the same thing, but we adjust in a different way. It's not about changing the cash flow like that one, but changing the probabilities. So the expectation of the P measure at the real probability, you like, is going to be something like your values taken in the different state of the nature. So let's say that we have S states, and those are weighted by those probabilities. And that defines the real probability. The more likely a state, the more you weight that result into forming expectation. And now what we are asking is to change the probabilities in such a way that the expectation is computed over the S states that define this discrete random variable, right? We work with the discrete random variable because it's much more intuitive to understand, right? Integrals, that's a kind of awkward, we don't perceive the world like that, but we kind of immediately understand. You know, I have 3 states of the nature, good, bad, better, worse, whatever. I can sort of assign a final probability to each of them. So that's the point. We're going to take the outcomes of the random variable, the outcomes of the payoff, and we are weighted with a different system of probabilities, Qs. The restriction is what we call, remember, the equivalent probability measure. If P is positive, then Q needs to be positive. If P is 0, then Q needs to be 0. That's the constraint in order to claim that P and Q are equivalent, which is kind of very mild, very weak. Just, you know, the only I'm saying is that if something cannot happen under the original probability space, it should not happen under this alternative probability system. And that's very, 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 very kind of weak condition, very mild condition. All right, so when we do that, what we sort of are able to track is this order. when we construct this expectation, somehow we manage to figure out what the certainty equivalent is. And when we change those probabilities in such a particular way, then we are entitled, because this numerator will match this numerator, then we are entitled to use the risk-free rate as a proper discounted factor. And of course, that's why this approach is named the risk-neutral valuation approach, because you are doing something, working with expectations, so analogy for randomness, but the distinctive feature is that we are discounting at the risk-free rate. And this is essential what a risk-neutral guy will do, working with an expectation and discounting at the risk-free rate. Only a risk-neutral will do that. Only that we are not requiring risk neutrality here. Remember the example last week? We asked Jesus, the expected value was 7,000. Jesus said, it will be fine, and for me, it will be fine to get 6,000. That's what a risk adverse guy would ask. The degree of error, the risk aversion determines how much you get away from the expected value. The more risk adverse you are, the more you are willing to give up. And for this risk adverse guy, knowing that this is 6,000, we could sort of solve this system. We could say something like that 6,000 needs to be equal to the first payout that we were talking about, 4,000, with certain probability Q, plus the second payoff, that was 10,000, weighted by 1 minus 2. And of course, there is a Q that solves this system, and this was 2/3. That's not the real probability. My point is, if you computed this expectation with 2/3, 1/3 probabilities, you will come up with something, let's call it, you like, a lucky guess. Just by pure luck, if you like, if you use these particular probabilities in this expectation, you recover a number which is the same as the certainty equivalent. So you could discount that with the risk-free rate, and you will end up at exactly the same valuation. So this is the whole point. We are gonna be able to track under certain conditions what those risk-neutral probabilities are in order to do valuation. And we need conditions. Here, the trick, I could identify those probabilities by asking Jesus, how much would you, I need a kind of equivalent source of information that tells me that. This is our favorite approach when it comes to derivative valuation. And there is a reason. There's a reason also. It's not a coincidence, it's not kind of I like that to do that, just because, derivatives sounds exotic to me, maybe I may go into more exotic approach like that. No, it's for some reason. And the reason is a derivative, so we have two assets. One is typically a stock, if you like, and then we have the derivative in the stock. For instance, we are going to talk about options. So we have a native or a primitive asset, such as stock, which of course is uncertain, and then we have something which is not independent of the stock. On the underlying, this stock is called the underlying asset. And it's the primitive asset. So for the primitive asset, we observe the price at time 0. We will be able to observe the price. And according to valuation equations, that price must result from something like this, right? We are working just in this simplest analysis in which we consider one price, one period, then that price must be like that. This is the source of information that we can exploit. When I have a derivative, I observe the underlying asset. And my question is, okay, you have an option, how much is the price of that option? And of course, I have a pricing equation. This pricing equation must hold for the stock and must hold for the option as well. I will say the price of this call option is the expectation, the conditional expectation, under the Q measure of the payoff of the option, and then you will be able to discount at the risk-free rate. Why we use this approach with options? Because by looking at the prices, we are able to identify, we are able to recover the Q measured probability. We observe the prices already, and there is information in that prices. Of course, what is the condition? Those need to be equilibrium prices. I need to trust this price, so I need equilibrium. And this equilibrium for the stock price, let's call it S, right? S0. This price, in order to be trusted, must be in equilibrium, and we state a condition of equilibrium that characterizes this neutral valuation. No arbitrage. We do no arbitrage. We have prices in equilibrium from which we can infer the Q measure, the set of probabilities that underlie this valuation that is already in the market. And with the Q measure, we apply the price of the equation. Then we will determine the price of the option. Okay?
What does capital Q stand for?
Capital Q is the measure, the risk measure, the risk measure. Okay? So the probability is Q. It's a standard notation. You call each of the probabilities P, and then we have this sort of fancy P to mean the probability measure and underlies that characterizes this set of probabilities. And the same for Q, for capital Q, is the probability, the risk neutral probability measure, and associated to that probability measure, you have the particular probabilities associated to each of the states. Okay? And the point is, these two things are different. This is the one that really underlies, but this is not the one that you observe. This is certainly not the one that we use in valuation, it's this one, in derivative valuation. Okay guys, so
We approximate through Q. It's
we go
approximate.
through Q in derivative valuation.
Wait, so you said Q is the risk neutral measure, the Q, capital Q, and Q is the other QI.
And so let's say we have the P measure with the probabilities. Remember, I have like a two states in the example that we had working last Friday, and we said we have this random variable taking 4,000, 10,000, with probability a half and a half. That's the P measure. And those are the probabilities under the P measure. And then we have defined a different probability measure, Q, and we give to the 4,000 and 10,000 a different set of probabilities. And those are the 2/3, 1/3. That's the one that solves for Jesus, that solves the equation. This is this will be called risk neutral probabilities, and the whole thing will be called the risk neutral measure. Okay? Because probabilities are measures. We don't see that, but the deep mathematics that are behind the probabilities are the one that underlies the theory of the measure. That's why it's so complicated. It's one of the most complicated areas in mathematics. Okay? It has this kind of weird terms. The probability measure, the Lebesgue measure, those things comes from this area, from this field.
I'm not confused with, so both formulas, the stock and the derivative option
Are the same equation applied to its particular context. Here you are working about the price, the current price, the fair value, the theoretical value of the stock, discounting the payoff of the stock. So let's say you discount how much this stock is gonna pay, it's gonna give you next period, and here you discount the payoff of the option. So by discounting with the same probabilities, the different payoff that this alternative asset is giving you, at the risk rate, you get the fair price. The structure of the equation is the same. It only applies to two different assets, and they have different payoffs. That's the only difference. the risk neutral measure is the same one, exactly the same probabilities that categorize the expectation to the left will be used later to the expectation to the right. So that's why we need this stock to learn how that price was determined. And when I have that knowledge, I use that knowledge on the option. Okay?
So I'm confused because on top, you use a summation for the price of stock. Here, you calculated the price of stock as well, or?
Because we already have 1 billion. The difference is we are working with 1 billion models.
Here.
Yeah, in our theory here, we are working to simplify 1 billion. And here I was putting an equation that goes into real terms. You don't have one to perpetuity. So you want to extend this equation, right? Okay, so this is a fair point. So, all right, I'm working with 1 period in order to make things much more intuitive, but how that would be in terms, in the realistic terms, just to take the summation over the infinite number of periods in which we have the expectation and the Q of this payoff, right? So let's say J, those infinite string of payoffs, so you need to visualize that, and then you will be discounting at the risk-free rate from that particular moment backwards, okay? We are working with just 1 period because like this linear there. Have 2 periods, then we have 2 payoff, bring them out here.
And then until you get that one is basically
What?
that one you said is basically all the periods.
All the periods. So here the same thing. All what you have. But here we have 1 period models in order to make the point. Okay guys, so let me then introduce this model and let me clarify something here. You're gonna see this model later in Finance 2. Finance 2 involves risk management, involves derivatives. And this is a kind of super well-known, one of the most well-known models in finance. You can see the original paper, and this is something that particularly for those of you who want to go into the PhD direction, this is a good advice always. We will give you a sketch of things, I will use my own words, I will use my own expressions. The best thing always is to go and read the paper. Okay, you give me that thing, I have a good picture of what is going on, but if I want to go into the detail, always go to the original source. And here you have, and in chapter 2 particularly that we are going to see a lot of well-known papers and references, you are given the original source. So it's one of the most well-known papers in finance. I don't know how many references may have this guy, a lot of them. It's an old paper, goes back to early 80s, 79 paper, and it's super well-known. So to me, my interest is understanding this framework, the risk neutral valuation. So I'm gonna take the simplest approach possible. I'm not gonna consider the different alternatives and variations that this model has. I'm just gonna stay to explain risk neutral, to make sure that this is understood, okay? And you will see later this model again in Finance 2. So it's gonna be very easier to understand that because it will be the second time you see it. But you will see that in greater detail to some extent in the context of derivative valuation. You will see the Black-Scholes model, you will see what we call the Greeks, the Vega option, all the stuff is going to be taught in that course. To me, it's just making sure how this risk neutral approach works, okay? So, we have a model which is very simple. And that was people, sometimes this is when people think, oh, this is very simple. Some people, there is a wrong idea. Some people tend to think that the more complicated the model, the more sophisticated the model, the better. That's not true necessarily. You want something intuitive, that's always an advantage. You have something powerful, not naive, that's sufficient. And this was part of the success of this model. This model was published after Black-Scholes. And the point is, see, this is Black-Scholes models, it's super complicated. At the time, it was kind of, top technology. And they came up with something that was not in the continuous time, where you have the equations that they had, but with something much simpler. So you can get and learn something much more intuitive. Alright, so let's describe this model, this economy. First of all, we're gonna have one period. So once again, 0 is where we are right now, making the decision. The end of the period, that could be 1 year, could be a quarter, whatever you may consider, is when the outcome of your decision realizes. And of course, that outcome is going to be uncertain. We always work with uncertainty in these models, and uncertainty comes at the end. The result is uncertainty. Whatever you have here at time t0 is known. Then we are going to have uncertainty by, let's say, a state variable, and we call it S. A state variable that takes 2 potential outcomes. It's a very simple model, and it's called binomial, not because we have 2 periods of time, but because we have 2 states of the nature. Just 2 states of the nature determined by a Latin variable that we do not share, and drives the economy. So let's call the up state and the down state. And these states will happen with certain probability, which are the real probabilities. So that will be the P measure. That happens with probability P and probability 1 minus P. Things are good or things are bad with probability P and probability 1 minus P. Okay? We will not work with those probabilities. And this is the critical point here. One of the critical points. I'm not going to work with these probabilities. I'm just characterizing this for your knowledge. Something depends on a state variable. The probabilities are unknown typically. We may estimate those things, but we don't need to rely on those probabilities. And then we have a market in which we have assets. One asset is going to be the stock. So that stock right now has a price that is going to be a 0. So it's known. The price of this stock is 0, is completely known. We observe that price. And that price will turn into something different 1 year, 1 period later, and that price is going to be S1. S1, the stock, is driven by the Latin state of the economy. So it's a risky variable because it commoves. And I would like you to slowly but surely get introduced to different way of thinking. The stock is risky, not because there is something in itself. The stock is risky because it commoves with a risk factor. The risk factor here is the state of the nature. This is the variable that is somehow determined exogenously. It's given to us. Someone, the goes through the dice up. The dice rolls again, down. And we don't control that. But this stock, the payoff of this stock, commoves with this risk factor. So you buy this stock, you expose yourself to the risk factor. And this is the uncertainty for us, the riskiness. This is gonna take my wealth up or down because the investment on this stock makes my wealth move with a certain factor. So S1, the new random variable that commoves, that is driven by the market, will take 2 values with probability P and probability 1 minus P. If things go up, S1 will go up, right? So we are here, it's 0. If things, let's go into the up state, we are going to move into something which is a 0 multiplied by certain value U. And if things go down, then we are going to get our original investment multiplied by a factor D, which is smaller. So you may think of, I'm gonna work always analytically. I'm making your brain used to work with analytics is particularly for those of you who want to go into the PhD, is a must. It's not, if I give you a particular sample here, you may tell me, Antonio, everything that you told me applies only to that particular values that you have chosen. So probably may be right, but what if you just pick up, cherry pick the right values? When we work analytically, we treat the more general case possible. So I'm gonna work always in this theoretical context. But for those of you, right, that may feel more uncomfortable with this way of working, let's give it some numbers. So let's say that the price today is a calico. That's what I accept. And what fractions could be those values? U, let's say that U is 1.2. So the S1, let's call it SU, right? If the price goes up, SU is going to be 120. It moves up to 120.
Antonio, is that a D?
This is a D. This is my D.
A T, T.
D,
D, okay.
D, the down.
It's a D. The other
An
one
up,
is a little
U, of
Ah.
up, my U. So
And we're multiplying.
we are multiplying. The
But
thing-
because it's the probability.
It's not a probability, it's a factor that increases.
So
It's
it's
an
the
increasing
risk
factor, it's like a growth rate.
Okay.
So let's say that for instance, U is 1.2, so you get a 20% extra.
And that's exogenous.
And that's something that is kind of driven exogenously. Exactly. You believe that the market will grow up 20%, so your 100 will become 120.
So it's kind of like it being auto-regulating. Like the value.
Can be
today
whatever you want
is
because
equal
I'm trying to put as less structure as we can.
Okay.
So you want to give it auto-regressive, give it. I'm saying eventually you have an expectation that the price will move up to whatever you believe.
Okay.
And it will go down up to whatever you believe. My restriction, my only logical restriction here is that up must be greater than down. This is the only, in this model, that I'm trying to put as less structure as possible in order to make it as the more general as possible. I just want U to be greater than D.
Perfect. And if you want to evaluate this model, how can we determine U or D?
That's your beliefs. Again, I give you that to you. One is still is a theoretical model. Now you tell me what is multi-P, or what is let's say, Ukrainian's war ends by the end of the next year.
I can take that.
And you will get a 20% extra return, the market will move up at 20%, and that's your belief. All right.
I can use the value of risk.
Whatever you want.
to determine the D.
Whatever you want. My point is, you believe that the market goes up, or that the market goes down. And that's going to be certain value that I call U and D. So let's say D is 0.80 to make it symmetric. It needs not to be symmetric. Just in my particular example, I'm going to take these numbers. But remember, we are working in an analytical context, which is as general as you may want. Any D, any U. But of course, with this logical abstraction, one takes you up, the other takes you down. So let's say that then SD is going to be 80. SU goes up like that, or the final price, take value SD, which is going to be the original price times this deflating factor, right? Now here I'm losing money. Or maybe not. You may tell me, what if I believe that the market goes 20% or 10%? Well, fine. I'm just saying one needs to be greater than the other, because otherwise you will have the same value, right? So here is like a minimum structure as possible. Understood here, guys? This is one of us. This is one asset. Then I want a second asset. This is super expensive. People understand the value placed by this asset. One of the most fundamental assets, if not the most fundamental asset in the market. And this has a property which is a unique property. It does not commute with the risk factor. This guy is going to be a deposit, if you like, but you want to put it in more general terms because we want to be in the financial markets. You may think in terms of a bond. This bond,
This is another example, Professor, for me to hear. This is another example.
no, this is a different asset. This economy is made out of two assets. One is the risky asset because it moves with the risk factor, and this other asset is different because it does not commute.
So can you explain again the U greater than D? Only the U greater than D. So Y has to be greater.
Why what?
The U. That one. You make a comment on that one. So I understood the other thing. Y has to be greater than D.
Because one needs to be greater than the other. And the one that goes up, we call it U. We may call it A or B. What I'm just saying is, I want two states. In one state, you have one stock price which is greater than in the other state. Now, these prices may be greater than the original, maybe lower, up to you. All I'm saying is, you expect two different prices, one greater than the other. Okay? And then we have a second asset. This is gonna have price, current price, unit. So we are normalized. We're gonna sort of make things simpler. Here, you may buy this bond by paying 1, and this asset is the risk-free rate. Sorry, is the risk-free asset, because whether you have up and down, it will give you 1 plus risk-free rate. If things go up, 1 plus risk-free rate. If things go down. So 1 plus risk-free rate will probably 1. You will get the same payoff independently of what happens. It does not commute with the risk factor. And that's a unique characteristic that opens the door for many things. People tend to underestimate the importance of the risk-free asset. Gives me a completely different thing. It opens an amazing door because it has a unique property which is not commonly with the risk factor. Now, this has massive implications. I have one asset that is going to go up and down, and if I want to give it a structure to the model, apparently I just need this, right? But now I have a second asset. This second asset will pay 1 plus risk-free rate in every state of the curve. This puts pressure on these things, on these bounds. U greater than D will not be enough if I have a second investment that yields 1 plus risk-free rate, whether rains or shines. Can you see? Can you see why? Victor, what happens? Angel.
Because of the payoff of a bond is after 1 year you get money.
So let me put it. We have this asset. We can go from 100 to 120 or to 80. Let's see that the risk-free rate is 5%. Is this model correct, or is something that is internally crashing? If I can make a 5% sure, if I have a 5% granted, is not this putting some pressure on the bounds in which the stock can move?
You have to discount by the risk-free rate.
We will discount it at the risk-free rate. But now I'm talking about the bounds in which the price moves.
We have to know P to make sure
To discount, and we will not work with P, Jesus. I'm putting P here just to give it the model, the full structural model, but we will not use that information. My question is,
Here, for example, the risk-free asset will give you 105 at the end. So
right,
And
right,
so technically,
everything's sound.
everything is sound. The premise, for example, if the risk-free asset is 75, because then,
Okay, put it, let's twist the other. The
okay,
risk-free
let's
rate
put it 140.
140 in the state up and in the state down.
No, I was meaning the risk-free asset.
No, leave,
Okay,
fix it, work into the action, work in the share.
110.
So let's say that you want to go with 140. Would be fine if we say down, I can take a model in which the amount that I'm going to take down is 100, let's say 10.
Yes, because we're going with the restriction.
No, but you
With big restriction. But my question is, would this be sound?
no,
Why
because
not?
you will always take the risk because the free asset, no matter which result you take in the risky asset, will give you higher profit.
No, this one gives me higher profit.
Yeah, Yeah, exactly. No matter which outcome you have when taking risk, it will give you a higher return than not taking risk.
You see that? The existence of this thing puts pressure, theoretical pressure, on the dynamics of something that is risky. This situation will create arbitrage opportunities. You see that? This thing is simply too good to be true. Because if this is true, then we can design the arbitrage. It's too good. And we are, remember, the arbitrage is the fantastic, is the best potential, it's so good investment that it's not even considered, strictly speaking, an investment. In an investment, you need to typically pay something and then risk for something possible. This is what typically happens in an investment. Arbitrage is something that you will not pay anything and you will have something positive with certain problem. I said that's the 100% chance, that will be the perfect arbitrage opportunity, but even if it happens with ITP, as long as I'm not risking, as long as I don't have to risk money and I don't have investment, that's still an arbitrage opportunity. If this is something that independently of our preferences, any individual would love. Free lunch, or the opportunity to get something for free. Let's say that I find 500 bill on the floor. That's the first type of arbitrage opportunity. Or I find a lottery ticket on the floor. That's the second type of opportunity. I'm paying nothing for the chance to get money. I risk nothing. It's just zero investment and the opportunity of getting either some gain or a gain for sure. If we have that scenario, that's a scenario triggering the arbitrage opportunity. So how can we design the arbitrage portfolio? You want to take advantage of the fact that the prices, both prices, SU and SD, are too high. How can you take advantage of that?
You borrow against the gates and purchase such.
You borrow, so at time zero, we are going to make two things. We borrow, how much?
As much as you can, because
I don't know, as much as you can, as much as you need. So how much you need to borrow? Victor, you borrow. You want to buy the stock.
Theoretically, you can borrow any amount.
Theoretically, I'm going to let you borrow in order to do the arbitrage. I'm going to remove any friction. All these models remove these frictions. You can borrow when you need in the conditions you need.
For simplicity, you can borrow 100 days.
You will need to borrow the price of the stock to buy the stock today. So I'm going to do it symbolically here. You will borrow, and then you get this money, the price of the stock. And then with this, you buy the stock. So this position has like a two legs. First you need to borrow, the amount that I need to buy the stock, and then I spend that money on the stock. That gives us a net position, which is zero, which is the first part, of course, of the portfolio, of the arbitrage portfolio. Zero investment. And I use that, the borrowing option. We say borrow from the bank and we buy the stock. We have a different terminology, which is a little bit more general. When we say borrow, I may say, I go short. And that gives you this money. This is the same idea as selling. But you may say, but you are selling something that you don't have. Okay, so we don't call it sell, pure sell, we call it short sell. You buy something, you sell something that you don't have. And we call it taking a short position. And then we buy the stock. This is called taking a long position. But in order to construct a portfolio which is self-financed, I need to combine these two positions, short and long. So the question is, on who I'm going short, on who I'm going long. I'm going short always on the cheap thing, and I'm going long on the expensive thing, because I want to profit from the difference. At time zero, there is no difference. That's part of the story. And making there is no difference, I get a portfolio with zero cost. So this is not truly speaking investment. Investment involves capital expenditure. I'm not spending anything here. All right? And then happens time equal to 1. And remember, at time equal to 1, we have the up and down situation. For the bond, for the deposit, this thing means nothing. You borrow this money, now you need to pay back. You got that debt, you got that loan, you will have to give back that loan with interest. So this is the risk of this operation. I will have to pay back this money. And if I think if here I don't put at least this money, then the operation will bring me losses. So this is what it will be like. In an arbitrage, whatever it happens here in the net, we should not be able to observe losses. Now what happens is two things. Either the price goes up, so my investment on the stock goes and pays the up pay, right? So it's SD times U, or it goes, and this happens with volatility P, or I go down and then we get this money. So the final position is kind of random. It will depend on which of the two stages materialize. So in the up state, we get this amount, but we have to pay this amount. So net would be this term. In the D state, we get this amount, but we have to pay back this amount. So we get this structure. This happens with volatility P, this happens with volatility 1 minus 2. Now, if U and V both are greater than 1 plus RF, then with 100%, this portfolio will materialize expected profit with zero investment, hence arbitrage. So this situation is forbidden. People will be immediately to buy, people will apply this VCP massively, putting pressure on the price of the stock. The price of the stock will go up, making U and D the potential to grow up weaker and weaker. This situation is forbidden. If we want a model in equilibrium, this is scenario in which 140 and 110 is simply something that cannot happen. Not for long. That will be, imagine, 1 second. 1.0001 seconds later, someone realizes the arbitrage opportunity. 1.0002 seconds later, someone is massively introducing disorder. And 1.0003 seconds later, prices adjust to correct this valuation. And the opportunity is gone. That lucky guy, the first that came, takes everything. And the market is in equilibrium from that moment. Can we observe?
I didn't understand very well. Can you explain again the short and long, the concept?
Is the terminology is what bothers you. We call it short. So it's like you can, we say buy. In order to say buy, the terminology in the financial markets, people say long. Taking a long position is buying something. And for us, that would be a natural thing. I go to a market, I want to buy, all right. People will say, I buy IBM, I took a long position on IBM. But then there's another possibility, and that's what motivates this distinction, which is when you do restore a short selling, which is selling something that you don't own.
That you don't own.
You don't own.
And how you do that?
In the financial markets, it's impossible, Natalia. It's like it's a financial agreement. You and I can bet as if we were the owner or the seller without really being so. For you, it's not natural. When you think, how can you? And this is a very common doubt when people that first time hear about the behavior of financial markets. I can understand that you buy something that you don't know, and then you are the owner, the new owner. You can also sell things that you don't really have.
And when are you supposed to give it? Like, to have
You get the money as if you were the seller. What happens is that you sell it today, at the same time you agree to buy it later. So you undo your position later. And we call this operation short selling or short position. Going short means that you sell something that you don't own, and you get the money with a bond. This is the equivalent of borrowing. And you see, you can do that, right? I can go to a bank and get a money as if I have sold a bond to them. And the point is that later in time, I will have to pay back that money. Now, you can do that with a bond, but you can do that with a stock as well. And that's the surpassing thing. You can sell stocks that you don't have. Not you, Natalia, believe me. They will not allow you, not me either, but specialized people in the financial markets are allowed to do that.
The loan, can you explain one more time the loan? The
The
short-
loan?
Yeah,
The loan is buying. That's this is the simplest thing. Classical operation, when you want to try it, you say, I have bought cryptocurrency. You have been long in crypto. Now the thing is, when you combine that position with another to get funding, then you are combining long and your short position.
What I was wondering is, if we're borrowing, like, are we borrowing the
Are
money?
we borrowing from a bank, if you like,
Like, we're borrowing the money to buy
the stock?
the stock.
Hence, you pay nothing out of your pocket.
But that's buying on margin, right? Or that's not. That buying on margin is when you borrow directly the stock.
You don't borrow here directly. This operation has two legs. First, you go to the bank, get the money, then you go into the stock market for the stock.
Okay.
All right, and that gives you this final thing. So if both prices are above the threshold, that's my arbitrage.
So on normal circumstances, because obviously arbitrage last seconds, you never gonna have that is never as income commonality, right? You won't have that as an error because technically that margin will disappear so fast
Literally, exactly.
that the common investor won't have access to that.
Exactly.
Right. So then in that sense, you and D will always be higher than the risk.
Well, that's the point. We know that at least one of them needs to be greater than the 1 plus risk premium rate. The existence of this premium means that at least the up needs to be up. What about D?
D has to go down.
Or can also be up?
What? No.
One of them, what I'm saying right now is both of them cannot be below. One of them must be up. What about the other? Can be both of them at the same time above? Because then we trigger the same arbitrage opportunity, just reverting the story. If they both are above, you go short on the bond, long on the stock. If they both are below, you revert the position, and then you go short on the stock, long, you see? Then you do proper short selling on the stock. So the takeaway, the final point is that when we want one stock, that condition was enough. But if we want a market in equilibrium, this is not enough. we need to impose a restriction, stronger restriction, which is this. If this condition is violated, in any way, you will get arbitrage opportunities. And automatically the market will correct the situation. So the market cannot be in equilibrium unless you have this kind of growth rates. There must be a chance to gain over the risk-free, and there must be a positive chance to lose money in terms of the risk-free rate. So for instance, I don't need to go down. Let's say that the risk-free rate was 5%, right? This is 1.05%. Up and down scenarios is wherever you gain more than 5% and wherever you gain less than 5%. So it's not necessarily that I lose money because everything goes down, but let's say that down is, for instance, the market grows but only 2%. Grows below the risk-free rate. So in an economic equilibrium, the risk-free rate and the stock prices, everything needs to sort of, move together in a certain way to make this possible. Otherwise, people would put pressure. Okay guys, we are there. If this is understood, now we are almost there to finish my story.
Yeah, one small question. So I understand the whole arbitrage stuff, but you started here from that assumption, the bond stuff, and then you move on to the arbitrage. So I didn't get the.
Because it is not coming, as I said, it's not that I'm bringing this because I want. This is a logical, internal implication of the model we are crafting. If I start from the stock, U needs to be greater than D. That's logical restriction. Only, it's not like you want a model, if otherwise U equals D makes no sense. But if I put the bond, the deposit, the risk-free asset together with the stock, that condition is not enough. And the new condition, the new intrinsically logical condition that emerges is that one. I mean, that implies that thing, right? There is no contradiction. But this is a kind of refinement. This is a stronger version of that condition. It's not just that D needs to be smaller than U. D needs to be smaller than 1 plus RF and smaller than U. Otherwise, this equilibrium, this market that we are designing will not work properly. Now, when this condition is met, you have equilibrium price. All right? And then we move. Okay. So we will have equilibrium prices. And that implies what? That implies that this equation, that equation needs to be true. I say the price today of something that pays in the future must be the expectation under the Q measure of whatever the payoff of that price, that asset, discounted at the risk rate. And this is a pricing equation that holds for everything that you have in the market. Everything. So you have a risk rate, you have a risk-free asset. The risk-free asset needs to satisfy that condition. And we see that is true trivially. One, which is the bottom price, must be equal to the expected value. So the payoff is 1 plus risk-free rate, right? And that we have it with quality Q plus 1 minus plus the risk-free rate, which is the other payoff, and that happens with quality 1 minus Q, and everything is going to be discounted with 1 plus risk-free rate. So this condition is trivially true. We see that, right? 1 equals 1. The condition is met by the risk-free asset. But this condition needs to be met by the risky asset as well. The pricing equation needs to hold true for the stock. So the current price, which is S0, needs to equal the payoff in the up scenario weighted with the Q probability. So I'm computing the expectation plus the payoff in the downward scenario weighted with the other probability. And we discount everything with the risk rate. If this is true, we will have a 0 times up times YPQ plus a 0 times D plus 1 minus Q discounted. And if this is true, I can solve this equation for Q. One equation, one unknown. And we can solve this equation for Q. This is the equivalent that I did yesterday. More sophisticated, much more sophisticated, not so naive as going to Jesus and asking, tell me what your certainty equivalent is. I'm looking at the stock market, and from the price that is traded in equilibrium, I can recover the Q probability. There is neutral probability. I can solve that. Guys, I hope, I pray the step is straightforward, because this is just pure algebraic manipulation. Solving this equation, you see, right? The zeros and the zeros disappear. We can sort of factor Q, and if you do that, we find that Q is 1 plus risk-free rate minus D divided by U minus D. This factor is the solution that comes from just rearranging this equation, the pricing equation. If the pricing equation is true, then Q must equal that value. So there is just one thing left here, which is this really a probability? When you do this operation, it is clear that I just do algebraic manipulation. So this is 100% certain. The question is, man, what are you going to get from that Q? That Q could be a negative value, and then it spoils everything that you are trying to construct. Or that Q may be 256, and that spoils the probability nature. In order to everything be consistently, internally consistent, that Q must be equal. So that Q must be greater than 0 and smaller than 1. Everything makes sense as long as Q is positive and Q is smaller than 1. If this is true, we are fine. If not, something in my logical construction was wrong. So Q greater than 0 means that this guy needs to be greater than 0, right? The denominator doesn't matter, U is different from D, so the denominator is a number, it's a positive number actually, but this is going to be greater than 0 if and only if 1 plus risk-free rate is greater than D. So this is meeting, this is granted the non-arbitrage condition. You want the market in equilibrium, this condition is to be satisfied, and that would imply automatically that this number that we get from this equation is positive. So that gives you this 50% of what we need in order to claim that this is a probability. And then for Q to be smaller than 1, then 1 plus risk-free rate minus D divided by U minus D needs to be smaller than 1. That means that 1 plus risk-free rate minus D needs to be smaller than U minus D. And from here, we learn that Q will be greater than 1 if and only if 1 plus risk-free rate is smaller than U. So once again, the condition implied by the non-arbitrage condition. In other words, Something brutally important appears here, which is the no arbitrage condition implies that Q is between 0 and 1. So the risk neutral measure exists under no arbitrage condition. The no arbitrage condition is all we need in order to be able to identify the risk neutral measure. And from the existing prices in the market, we can recover that measure. There are a couple of things that we need to remark here. No arbitrage condition implies the existence of a risk neutral measure. The opposite, holds true as well, only that we cannot prove it here in this context. Mathematically, this is what we need to state. The if and only if condition. This arrow in two directions, which is the most powerful identification in mathematics. The if and only if condition. The bijective identification. If this is true, this is true. But if this is true, this is true as well. No arbitrage condition implies the existence of a risk neutral measure. The existence of a risk neutral measure implies no arbitrage. It's the same thing. It's the same thing expressed in different with different words. This is one of the most powerful results in finance. When you have this condition for equilibrium market, for equilibrium, which is requiring no arbitrage, that automatically grants the existence of a risk neutral measure, of the risk neutral probabilities. And now, a second thing happens here. Alright, you grant the existence of a solution, but that's not enough for me. I need one solution to the problem. You want risk neutral probabilities, but it needs to be only one in order to have just one set of valuation. So the no arbitrage condition is not enough for that thing. No arbitrage means that we are able to find at least one Q probability, which is between 0 and 1. If you want just one single probability, you need another condition. And this condition is called market completeness. The market must be complete, and when that happens, Q is a probability measure and is unique. And this is the things that we need to determine a single price. So please notice the very subtle difference here. If I just have non-arbitrage, I grant at least one solution to the problem. But that's not enough for me in order to make things sound, economically speaking. I want just one price. One price means one Q. That means another condition, which is not, unfortunately, is not enough just with non-arbitrage condition. We call it market completeness. For those of you who are in the macro track, you probably have already talked about market completeness, right?
Yeah.
It sounds a ring. It's a very important concept in economics, market completeness. For those of you who are in the finance, paradoxically, for those of you who are in the finance track, this may be kind of blurred. What do you mean? What do you mean by unique solution? In this model, we see how smart the authors were. And the constraint to impose market completeness comes from the fact that they are considering just two states of the nature. Why binomial? Because that's what you need in this context to ensure market completeness. What happens, let me put it in other words. Let's try to figure out a more general market in which, let's say that we don't have just two states, we have 3 states. For instance, why not 3 states, right? Or 4 states. 2 states allows for uncertainty, of course, but it's actually the most demanding way. It's the most restrictive version of uncertainty. Just 2 states. It's a binomial distribution. Why not having the final price to be, let's say, go go very high, go medium, and go low. 3 regimes. Each one having with P1, P2, and let's say 1 minus P1 and minus P2. No arbitrage, I give you that. Then, if we define the equation, the price, the current price would be what? Whatever you have, the payoff that you have in this stage that we have called high, weighted by P1, plus the payoff of your share when you are in this medium state, and that will be P2, and the payoff in low with this 1 minus P2 and P1. And all these things need to be discounted by the risk-free rate. Now, what you have is one equation, 2 unknowns. You see that? If we stay at the binomial model, we have one equation, one unknown, P, Q, so we can solve it. Now, we can solve this equation, but it has infinite solutions. This is the incompleteness. And why the market is complete? Because we have 2 assets, we have the bond, and we have the stock, but we have 3 states of the nature. This is market incompleteness. Incompleteness meaning that you lack something. You have more uncertainty in the states of the nature than non-redundant assets. So you cannot hedge everything. You are missing something. Then you have infinite number of solutions to the problem. When you stay to the binomial model, you have 2 assets, 2 states of the nature. Market is complete. You can solve the system for a single solution that prices everything. And then we reach the end. When we identify the Q, now we price everything. And everything here is going to be the option. What I'm missing is the price of a third class of asset in this context. By the way, you tell me, Antonio, but if we have the bond, the stock, and the option, couldn't we consider the 3 states of the nature? The answer would be no, because the option is redundant. The option takes values upon the values taken by the share. That's why it's called derivative. So it's a redundant asset. The uncertainty of the stock and the uncertainty surrounded by the option is the same one. So you cannot hedge, you cannot complete the market with the option. You need native investments. And you need at least one for each state of the nature. Market incompleteness is a huge problem for people doing theoretical economics. It's a huge consideration because markets must be incomplete. There are many different sources of uncertainty. But in the theoretical models, you need to contain that if you want to end up with what is called closed form solutions to the problem. When I need a unique solution to the problem. So I need as many unknown, as many equations as unknowns.
Perfect. And if I get a third asset that is not correlated with it's not a derivative.
It's not bringing information. That's the point. If you give me, I have a third card, I have a portfolio, I have a basket which combines the bond and the stock. That's cheating. That's not bringing me anything new. You are just recombining what you have. That's what we call a redundant asset. You may have that. You may have an index. An index is a linear combination of underlying assets. It's a redundant combination. So you can price that thing based on the primitive investments. What I want is primitive things.
Yeah, even if I have gold.
Gold may count, crypto may count, but the point is that, all right, you go to 3 states, 4 states, 5 states. You are restricting the number of states that I can allow to the number of primitive investments that I can consider. More questions, guys?
I have 2 questions. So whenever you have more than 2 states, the market is incomplete.
If you don't have at least as many assets as the number, you have to have at least as primitive assets, as I said, bond, a stock, a completely aggregated stock. Those things allow me to complete the market.
One value for each stake.
And the intuition here is, in this equation, this is the present equation that we need to solve for the probabilities. Each probability is related to one state of the nature. You must have as many of these equations. I need, so for instance, if I have three assets, if I have three states of the nature, right? P1, P2, 1 minus P minus P2, I have the bond, I have stock, and then we need a second stock, so let's call it is 02, in which I may have to use a different base in order to define a new equation that I can combine, and I need to have as many equations as they are now in the problem. So I will have to rely on this second step to be able, in a system of equations, to identify this thing. People in economics probably have heard of the Arrow-Debreu, and have you heard of the Arrow-Debreu prices in macro? Not yet? You will. This is strongly related to that. You will hear of that very soon. The Arrow-Debreu prices. The Arrow-Debreu, this is all about that.
So when you don't have, when the market is incomplete,
Market is incomplete, then
you
what
can-
happens?
you can reduce, so try to reduce it to two states of nature.
The simple example would be this thing. I have just two stocks, I have one stock and the bond, and I have three states of the nature. So I have an equation with two unknowns, two probabilities, but only one equation that gives me infinite solutions. So you come up with infinite systems of probabilities that satisfy the restriction.
But is that useful?
No,
Entonces, o sea,
then you are, it was a bad word here, you are broke up, let's say, you have a problem because you cannot end up with a model. You cannot end up with Natalia, is mathematically you want just one price.
so-
You may tell me if you apply probability system 1, you get this price, but if you get probability system 2, you get a complete mathematically acceptable solution to the same problem, but it gives you a different price. And the same object cannot have two prices. So we are in a useless situation. I need, in order to value things, I need the existence of the limit probabilities, which is granted by the normative condition. So it's like a yay, fantastic. Unfortunately, that's not enough. You need that condition and market completeness in order to have just a single system of probabilities that solve this, the equation, literally.
but is there a way to reduce, like to compact, o sea, comprimir, like
Squeeze.
to squeeze, like the incomplete values, no? So to make it able to calculate.
You need to give a structure to your model and make assumptions in order to
So
remove
you-
sources of uncertainty. For instance, in real life, you may consider that the risk-free rate also evolves. You don't know, you know what the risk-free rate is now, but you don't know what the risk-free rate will be next period. So you may, then that takes you away to another source of uncertainty, market completeness. Why do you assume a risk-free rate? Because you need your model to be able to generate solutions in the complete system.
Okay.
So one thing is the reality, and another thing is our models. And our models must be constrained by logical things. I want something to give me to be able, black source model. Why this structure? Why this particular structure? Is this super realistic? And the answer is no. But if you want to end up with a solution, you need to have one equation, and that goes under the complete assumption. Something that makes possible the completeness in your, not necessarily in the real life. Your model must be complete.
But in reality, it's
Reality is much more
complete.
reality is much harder. In real life, we don't have. It's like I need market. It's like Victor said before, right? So I can have I can borrow, I can borrow without restrictions. My model will see me and yes, you got anything you want. Real life, no. Just to begin, you will not be able, not even to take short positions. Institutional investor can. I cannot. These models say anyone can make the non-arbitrage holds as long as people can sort of remove the arbitrage opportunities immediately. That needs assumptions that probably are not true in real life. But as I said, students, first year PhD students particularly, tend to believe in our models as if that was the truth. Models as a simplification of life, which you need to have this kind of trade-off. I want something that needs to be realistic enough, but on the other hand, if it is too realistic and too much general, I end up with no solution. What the hell are we doing then? Right? I need a kind of system that allows me to price this thing. And if I need to take assumptions, all right, let's discuss what those assumptions are. But one thing is, and probably I'm going to repeat this very often in this course, because it's like that. One thing is your model and the assumptions that characterize your model, and another thing is real life. So one model is better than another when sort of represents real life in a much more appropriate way, and still is able to. The problem is I need to have a solution to this thing. The model needs to work. If the model is very realistic, but is so complicated that it's untractable, go to the rubbish. No one will waste 1 minute in that model.
And a model that never never approximates reality or like never guesses reality. O sea, a model that never.
We judge, we are very pragmatic in these things. You make wrong assumptions, but if your model makes predictions, let's say that this model generates values. I price an option with this thing. And then I go to the market and I say, see, my model says that this option should be traded around 20 euros. And I go there and I find that these guys are trading that option to 20.3. I will say, man, I don't know what your model is doing, but it is capturing the essence. Give me this model. I take it, I buy it. On the other hand, you have a model which is super sophisticated, artificial intelligence or whatever, and you find something like I want a picture of German soldiers in the World War II. Have you seen these critiques today? And then you see soldiers in the German soldiers in the World War II. It was super funny because they were black. So it's like the artificial intelligence somehow sort of mix it and put this is not a realistic picture because they were Nazis. No, not even one. They were Nazis. But in the artificial intelligence, the algorithms make that thing very fast, very quickly, but prone to those errors. Of course, those things will be corrected as the new models evolve. But these models are wrong because they are judged by those predictions. If you give me that, this is unreliable. Okay. So guys, let me just take 10 minutes more. We go for the break, and finish with the call option because it's right. We have it right there.
Yeah, my question was following up on Rachel's question. It's like you get, let's say you have crypto, and that you have crypto, you could have technically that structure. You will have one. The problem is that any asset you bring me, I will ask you for another state. That's more complexity, right?
Exactly. Because at the end of the day, you will end up with how many different assets you can combine? 100. Why not having a complicated model with 200 states of the nature? You will be missing that. Okay? Alright, guys, so let me finish this with the option, which is the purpose of this paper. To me, the most interesting part was this discussion. This neutral probability should be understood by now. But let me have the real payoff, right? Like the purpose of this model. An option, an European option, gives you a right, but not the obligation. And this is super important. Gives you the possibility of doing that if that's in your interest. If this is not in your interest, forget it. You have the right, a call option, gives you the right to buy a share, to buy a stock, but not the obligation in a given date. At maturity, we say. So the dynamics is very simple. T0 is now. Let's go to a moment in time that we call maturity. The stock price is over here, right now. And then the stock price will evolve over time. Up, down, whatever. Now, I want the right to buy the stock paying K. And this is called strike. So let's say they put a sort of bound here, and this is K. I want, let's say, in 1 year, the right. And the right means if it is to my interest, I will pay K. If not, forget it. No, this never happened. But 1 year ahead, if it is in my interest, I want the right to buy this stock paying K, independently of the market conditions. So, if the price of the stock goes above the strike, this option pays off. It makes sense what we did. Today, I sort of agree, I settle an agreement in which we say, in a year, I will pay for the stock, let's say 135. And the stock next year has a price which is 150. Then you can buy something that is worth 150, paying just 135. That's the right that you acquired 1 year later. But what happens if the price goes below the strike? Then I don't buy it. I'm not gonna pay 135 for something that is worth only 80. So this is where I invoke my right. Remember, I had the right, not the obligation. Now it's not in my interest to pay 135. Forget it. I invoke my right. That's the option. You want something more symmetric? That's called future. We agree that I will buy yes or yes for 135. So I can make money or lose depending on whether the underlying stock goes up or down. That's a future, and it's a different animal. It's more symmetric. So we may agree not to pay anything. Two sides enter into a future contract and they pay themselves with this opposite expectation. If I take the right position and the price goes up, I will be able to buy at this fixed price that was in my advantage. But if the price goes down, I will have to pay in that moment. That's the future and implies no current price right now. The option gives you a right in the future, so the payoff is positive. It's limited liability. You, in the future, cannot, whatever it happens, because you have a right, you have an option, you cannot lose money in the future. Worst case scenario, you say, forget it, zero. Best case scenario, if the option gets in what is called in the money region, and then we go and we say, remember, we agreed that I will pay 135, and now it's time for me to honor that commitment. So, where is the payoff of the option? If
the SU minus the K.
use SU minus K in the up scenario, right? If things go in your favor, and if things go wrong, what? Zero. So it's the maximum of this amount. In the up scenario, the stock price goes up to SU. The difference is your profit, right? You can buy for 135 something that is worth 150. You make a gain of 15 units or zero. So it's the maximum of these two amounts. Wherever you get a difference, if that difference is negative, forget it. If that difference is positive, that's the payoff. That's the payoff in the up scenario. In the down scenario, it's exactly the same thing, but now it's the maximum between SD, because the price of the stock went down, but still, even going down, perhaps is above K, the strike. So the same structure, only that the price of the stock is changing, switching from SU to SD. Okay? So now we can price the option knowing the risk neutral probabilities. And that's the model. The model tells you, all right, so you have identified the payoff of the option. SU, maximum between S0 U minus K if things go up, maximum between S0 D minus K and 0 if things go wrong. So the expected value of those things is this thing weighted by Q plus this thing weighted by 1 minus Q. You discount that expectation, that's the value of the option. This is simple. So let me give you values because right now it's a formula, I hope very transparent, so we can give it values immediately. So let's say for instance that today the price was 100, we expect U to be 1.2 and D 1.8. So SU is 120, 100 times 1.2, so we expect an increment of 20%, and we expect in the lowest scenario a loss of 20%. So we go for 100 to just 80. The strike, let's put it in 100. I want to buy, I want to have the right to buy something next period, pay 100, just 100, the current price right now. How much should I pay for the option to do that? And the answer is going to be, okay, if K is 100, then if the price go to 120, you will be able to pay 100 for something that is worth 120. So the payoff of the option in that scenario would be 20, right? If the price goes up to 120 and you fix the strike of 100, you save those 20 units. Sorry, I'm done. Then, if the price goes up to 80, that's below the strike, then you will say, I'm not going to pay 100 for something that is only worth 80. So forget it. So the payoff of the option is 0. Now, by solving the equation of the risk neutral probability, if we go to this expression with U 1.2, D 0.8, risk-free rate 0.05, Q is 6 and is unique, that's 0.625, so 62.5% weights the payoff of 20, 37.5% weights 0. So that gives you a price, this neutral valuation price for the option of 11.9. If you want the right next year to pay, to be able to buy a stock, paying 100, whatever the scenario is, that person that is selling this option should earn 11.9 today. It's a right, if you want that right, you need to pay. And that will be the fair value difference of the option. Is understood, guys?
So Q the probability, right?
There is neutral probability, not the real probabilities. And that's the critical point. In this scenario, I have not characterized real probabilities in any moment. I said, what was the real probability of going up to 100? I don't know, because you don't need it. I just figure out to reconstruct the risk neutral probability, and that's the one that we are using. Is this clear, guys?
11.8 is the price of the option.
11 is the price today of the option. This model is super well known because they have something, and you will see that in finance too. I'm not going to enter that. I'm not going to push too much. But if you generalize this model by allowing, say, okay, what if we have just one step, right? We say it needs to be binomial, otherwise we don't have market completeness. But what happens if rather than just one period, we have 2 periods? Then you start from 0, right? You move up and down, and then you repeat. In the second period, you go up and down, you go up and down. What happens if you do this thing many times? You divide the total operation in a continuous space. You have like a kind of multinomial tree. And you do this thing, you do this exercise, dividing, let's say, so if I consider 2 periods, I'm dividing the total length of 1 in 2. If I consider 4 periods, then I'm adding 1/4, right? I have 4 steps. I'm dividing the total length in 4 pieces, and that's making up a tree that is growing exponentially, more and more nodes. If I consider h periods, I have length, sub-periods of length, which is 1/h. What happens if I allow h to go to infinity? In other words, what happens if I allow this price to evolve rather than in those discrete steps to evolve continuously over time?
So it's not over some, it's
Is then you go into an integral and the Black-Scholes models appears.
Also, the Black-Scholes is for continuity.
This model is what happens the other way around. Black-Scholes is what happens when you take this model and allow the price to change infinitesimally fast over time. Rather than just taking this discrete step, right? 1 period. Now and next year. Now, this 1 period dividing in tiny and tiny and tiny sub-periods. When you allow us to go to the increment to go to 0, so infinitesimal changes, that's continuous time dynamics that takes you to the Black-Scholes models. And you will have to see that in furniture. But that's the beauty also of this model. The guys improve in their paper, see those complicated equations appear as the limited in our framework when we do this. That's fantastic because it allows you to understand the Black-Scholes models from another perspective. In all courses in finance in the world, all master finance programs, and even in undergraduate levels, they explain the binomial model. Probably those of you who have seen in undergrad level, have you seen the binomial model before? No? Yeah? You already seen it. That's it. Some universities explain it in the undergrad level, all master programs that have derivative courses, risk management courses, explain Black-Scholes models, RIGS, blah, 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 and the introduction to that is through the SEAL model. So, in my case, I'm not interested in that. I'm interested in the concept of the risk neutral valuation, the principle that makes the wheels spin. That's what I'm interested in this course. And because that was new, and that's, of course, everything that is new always comes with a friction, hopefully that friction should disappear now. It's like a pointed, like a,
The thing I have trouble understanding is the difference between C0 and S0. The current price.
C0 and S0. S0 is the price of the stock. And C0 is the price of the option. And C0 is contingent to the price of the stock. It's not independent of, and that's the point, it's a redundant asset as we defined it before. Depending on the price of the stock, you will have a payoff, and depending on the payoff, you will have a different price of the stock, of the option. So the price of the option cannot be independent of the price of the stock. It's a combination, actually, you see that, it's a combination of the price of the risk-free asset and the bond. And actually, the proof in the actual models goes along those ways. You price arbitrage portfolios. The argument, of course, finance can take very many different approaches. One of them is to see the price of this. I see the option as a combination of assets. By pricing the individual equation which is given by the non-arbitrage conditions, I am able to price in the Black-Scholes models, for instance, the option. Guys, let's go for 15 minutes break, well deserved today, and then we finish the class with the wash.